Hey everybody, this is Jim Musgrave. Thank you for joining my Q1 2024 market update. Uh, I'm going to start in just a second. If you guys could write in the chat that you can hear me and see me, I'd really appreciate it. So I just want to make sure that you guys can see me and hear me, and that would certainly help out. So anyway, if you guys could just kind of put in the chat or the Q&A, that would be wonderful, so I can kind of hear you. So I'm gonna, okay. All right, hey, thanks for the feedback. So Happy New Year, everybody. This is great that you're joining me. Hey, just a couple little things here. If you guys are not familiar with this format, in the upper, let me kind of go to the audience view right here. So in the upper right part of the screen, you'll see chat, Q&A, polls, and handouts. Go ahead and click on handouts, and you're going to see a lot of stuff right there. Again, my bio, the actual slides to a lot of the material that I'm covering tonight. So we got anatomy of a recession. There's also the actual slides, the PowerPoint slides that are now on a PDF. They're there as well. We also have some information about some of the portfolio models of what I've been using, the GA Select. And there's also 2024 tax summary to kind of get up to sort of my cheat sheet on the tax summary. So you should also receive an email that has a link to all these handouts as well. But to make sure that you got it, go ahead and download these handouts. You can just like literally download each one at a time and just kind of save them in a folder somewhere. So that's the handouts. There will also be doing some polls, so you can click on the polls. Actually, I think the polls will show up when I make them live, but anyway, we'll be doing some polls. And we also have the chat room that you guys are familiar with. Thanks for the feedback and so forth. So great. Hey, Pete down in Birmingham, you're joining me tonight. Awesome. So anyway, I'm going to get started. So I actually gave this presentation live to some clients here in Bethesda. They came to Seasons 52. And for those of you guys you couldn't make it, obviously you're joining the webinar. But anyway, I'm going to try to go through this. I mean, I got so much stuff I want to cover with you. So let me just kind of start here with sort of the agenda. So what I'm going to be covering are, again, there's a lot going on here at Musgrave Financial Solutions. We got more resources and adding more value. I'm going to kind of cover that. Then we're going to kind of get to a market update. And so I'm going to kind of give you a condensed version of what it is, but I'm also going to show you the resources that I go to kind of interpret what's going on in the markets. And obviously, in the last couple of years, the Fed has been raising interest rates, and the debate is, well, are we going to have a soft landing, which means no bear market recession, or are we going to have a bear market recession? So we're going to kind of see the pros and cons of both of those arguments. And if we do have a bear market recession, I want to cover different ways on how you can prepare for that. Again, bear market recessions are just a part of the markets. They happen all the time. We've seen this movie before. And the time to prepare for a big market downturn is before it happens, okay? Which leads me to my last bullet point. So we're going to give you 10 ways to grow and preserve your assets and also prepare for a bear market recession if that happens. So anyway, if you guys have any questions, you can certainly put things in the chat. You can put it in the Q&A, and I will I'll make an effort to look that way and answer your questions. So, all right, I'm going to get right to it here. So, more resources, more value, again, the starting line of 2024. So the first thing I want to do is that we actually have a new member of the team. Her name is Robin Drews, and she just started in the last couple weeks. And so she is an advisor who's going to be really helping me help you guys. And so she's the latest member of the, thank you for the emojis. Thank you for the love. But anyway, Robin is a new member of the team. Obviously, I got my Rockstar Service Manager, Vince, who's also on the team. So we've got a strong team. And let mean, ultimately what we're trying to do is serve you better and to provide better service. And so with Robin on board, we're able to do that. Okay, so this is my website, and you know what I'm going to do? I'm actually going to switch screens, and I'm going to actually share with you my website. Okay. All right. Now, what you're seeing right here is you see the couples on the beach with their hands behind their head and looking at the water. So this is the kind of image that we want to kind of have, in the middle of January. But as you scroll down right here, you're going to see the areas that we work in. We've been spending a lot of time updating the website with a lot of great information. And again, there's a handful of you who are on the call. So again, by the way, this is a call for my existing clients. I've invited a lot of people to join us because I feel that this is great information. So if you kind of want a recap of sort of how we approach planning or want to know more, I highly recommend watching these 2 videos on our approach to planning and how we kind of differentiate ourselves. I won't go into that in a moment, but we've got some details on how I approach planning versus other people that you might be working with or not working with. We also have our client service levels and fee schedule, which I can't remember if I put that in the handouts or not, but you can click right here on this page and look at our value proposition, which I'll go into that at the end. You can also see we put our educational workshops. This is the webinar that you're seeing right now. The next seminar I'm giving is going to be March the 5th and 7th at the Rockville Memorial Library. We're going to be doing another Social Security seminar there. And I got some other stuff coming up that I'll share with you, but you can always see our latest educational workshops right here on the homepage. And you're going to see a theme as for those of you who know me, I am passionate about financial education. So I just came back from the Circle of Wealth conference down in Orlando a couple weeks ago. And this was so actually the main guy who heads up the Florida State University economics department actually teaches a course on financial literacy. So this is a college level course that they teach, and they actually use the same concepts and material that I've been using with my clients through the Circle of Wealth. And what you're seeing right there on the website is a free kind of, I guess, starter financial literacy course. So you can literally sign up for this. It doesn't cost anything. But if you want to go into more detail, we actually have the full semester that you can get. It's probably 24 different modules on different concepts. So again, this is something that everybody should be looking at is continuing their financial education. They charge $100 for it, but if you let me know, I can give you a $20 discount and get it down to roughly $80. So I kind of recommend that. And again, this is what I was going to talk about. At the bottom of my homepage, I update these resources every quarter. And I highly recommend you guys visit them. One is that, so a lot of the material that I'm covering tonight comes from 2 different sources. One is called the Franklin Templeton Guide, Anatomy of a Recession. So if you click right here, and I'm actually going to share this tab instead. This actually takes you to the Franklin Templeton website with the Anatomy of a Recession. I actually saw this guy, Jeff Schultz, down at the ETF conference many years ago. Loved what he was doing. And they have videos that you can watch on their take on what's moving the markets. But this is what I love right here. I'm going to go into more detail about this, but they actually have their recession risk indicator matrix. So they take 12 economic indicators and they give us their take on where we are. So I'll just give you a little hint. The overall signal right now is recessionary. How can that be when you actually have a market that we've hit all-time highs? Stay tuned. I'm going to kind of give you some insights on that. But actually, if you don't want to take my word for it, fine. Just scroll right down here and you can see all this stuff. But there's also, just scrolling down, you can watch this video right here. So this is what he just did, his update recently, and he goes into a lot more detail. So if you want to hear this information from the horse's mouth, recommend to do it. And you could also download the Anatomy of a Recession presentation. Here are the PDFs. So what I've done in my presentation, I've kind of taken this stuff and condensed it. But if you want to kind of dig this, roll up your sleeves and see more detail on sort of economic stuff, I'm just kind of sharing with you where to find this information. Okay. All right. So let me share this tab instead. The other thing is also the JP Morgan Guide to the Markets. And you can see this right here. This is another quarterly report that you can download. And if you scroll down right here, you have Dr. David Kelly kind of giving us his take on what's moving the markets in 2024. So again, you may or may not have any interest in this, but for those of you who do, I want to give you the sources that I go to. Okay. All right. So let me kind of stop sharing this, and we will go back to here and get back to the presentation. All right. Try and get this technology working. All right. So that was a little bit of the website. Okay. Now here's some other exciting stuff that's going on. As you know, a lot of you have come to me through the Social Security seminar, but I've got some other topics that are going. One is that big thing I've been talking to everybody about are the potential of rising taxes. The Tax Cuts and Jobs Act will most, the tax laws will most likely expire at the end of 2025. So a lot of the conversations I'm having are Roth conversions. So I actually have a presentation on how to design the optimal Roth conversion strategy. So that's going to be exciting. I also have another seminar on how to minimize taxes in your taxable accounts without sacrificing performance. And I'm going to talk to you a little bit about that towards the end. So please stay to the end. I got some great stuff to kind of share with you. But, for money that's not in 401ks, IRAs, qualified plans, again, taxes is one of the biggest wealth transfers that we all face. So I'm going to share with you great ways to ultimately minimize taxes in your non-qualified accounts. And we also actually have another one called Maximizing Your Legacy. So obviously you want to have enough money in retirement to maintain your standard of living. But for many of us, we're going to have leftover money. So we ultimately, for most people, we want our estates to flow to our families. And again, when we die, our money can either go to our families, charity, or the government in terms of taxes. You choose. So most people would like to have most of their estate to go to their family or charities with as little going to the government as possible in terms of taxes. So in that workshop, we're actually going to kind of share different ways that you can pass more of your estate more tax efficiently to your heirs and beneficiaries. So that's one thing that we're going to be doing. The other thing is that this kind of leads me to my first poll, is that I know there are a lot of really, really smart people on this call. All right. So my question for you, I'm just going to start this up here, is that would you like to be on my advisory board to give me feedback when I'm doing my new educational workshops? I'm creating this stuff from scratch. And so what the process is I do it. I think I do a pretty good job. I submit it to compliance, but I don't know if I'm doing a good job. I need your feedback. Okay. So again, this is voluntary, but if you guys would love to be, if you'd like to be on my advisory board to give me feedback, how can I present this information better? Right? Jim, you lost me right here. I'm not sure. I didn't really get that. Or you went too long, or maybe if you should focus more on this area. That's the kind of stuff that I need. And so if you're willing to be on my advisory board, just say, yes or no. If not, people, you're busy, no problem. I'm just trying to get an indication of those who want to be on there. So anyway, certainly appreciate the feedback there. I'll kind of go on, but I'll let that poll question stay up a little bit longer. Okay. All right. Now, another really exciting thing is that I'm going to be starting a podcast. Actually, I'm going to be recording the first 4 podcasts this Friday. And so I actually have a professional studio kind of producing this stuff. And so I already have the first 2 months or first 8 episodes already planned out. And then we're going to be doing all sorts of great stuff. So anyway, we will let you know about the podcasts that are coming out. So I'm going to be kind of putting that on YouTube. So that's one thing that I can really use your help is, when I send this stuff out, if you just hit like or subscribe to my YouTube channel. This is true value added, short, concise education little pieces. And so again, I'm going to try to keep them to no longer than 10 or 15 minutes. but I'm really trying to get this out and to try to just get the word out that we're doing great things and providing good information here. Okay. All right. Now, again, most of you here on the call are existing clients. If you're not an existing client, that's okay. I actually have a gift for you. And the gift for you, if you're not an existing client, is that I will give you access to our very high-end planning software that is basically exclusively for our existing clients. Again, so there's a little survey at the end, so we basically we're going to kind of follow up with you. But if you want to schedule a time to kind of go over this and kind of review things, that's when you'll get access to what we call Money Guide Pro. So hopefully, if you're an existing client of mine, that you already have a username and password. If you don't, no big deal. Just and actually, if you just kind of put in the chat, if you don't have access to Money Guide Pro, just say, hey, I need access, and we can kind of follow up on that. But anyway, we're going to kind of follow up with the people on the call, or you guys on the call tomorrow, just to kind of follow up on things. So, but the thing about Money Guide Pro is what we've been using is that if you've never used it before, it's a great software to kind of take a snapshot of where you are. You identify your concerns, and we kind of prioritize them. And we also kind of break down your income goals in terms of what are your needs in terms of money that you need, what are your wants, and what are your wishes. And as we go through that and we input the different investments, the different sources of income, Social Security, pensions, real estate income, those sorts of things, we enter in the assets in terms of the equity in your house, your mortgages, debt. There's a place to put in insurance policies. So what we're trying to do is we're trying to take a snapshot of the overall finances. And once we take a snapshot, the next screen is the probability of success. All right. So the question is, are you on track to maintain your standard of living? It's either a yes or no answer. And what the software does, it gives you a gauge in terms of the probability of success. Now, obviously, we all want to be on track, but if we're not on track, we need to know. And the sooner that we know this, the more things that we can do to put us in the right direction. Okay, so there are 4 questions that we all need to know the answer to. The number one question is, well, what kind of rate of return do we need in our investments to build our portfolio to a point where we can take money out and maintain our standard of living throughout our life expectancy? So the first question is, what kind of rate of return do we need? Do you guys know what rate of return you need on your investments? Okay. If not, would you like to know? Okay. The second question that we need to know is, well, how much money do we need to save in order to build our portfolio to the point where we can pull money out and not run out of money and maintain our standard of living throughout our life expectancy? So the second question is, like, how much money do I need to save? The third question is, well, when can I retire and maintain my standard of living? A lot of people have an idea in their head, like, hey, I want to retire at that age. Well, what do the numbers say? Okay, so that's the third question, is that, are you on track? And if you're not, would you like to know? And the fourth question that everybody needs to know is, all right, well, if you're not on track and you're not fully funded, how much of your lifestyle will you have to reduce if you're not on track? Okay, some people's like, I'm not going to work any longer. I got what I got. And they're going to maybe forced to reduce their lifestyle. Okay, so those are 4, what I call the 4 most important questions that we can kind of answer in this software and also another software package. But I want you to be thinking about, and I'm going to talk to you about this a little more towards the end. I want you to be thinking about your adult children. Okay, so think about your adult children who might be in their 20s, 30s, 40s, however old they are. But they need to know the answers to those 4 questions. Okay, so that's one of the things that we're trying to be very proactive, that we feel that not only you should have this information, but also your adult children. Okay, so that's a Money Guide Pro. We want to make sure that everybody has access to it. Another software program that we use for people who are retired and we're trying to do income planning. All right, it's called Income Solver. Okay. And this is a really robust software. So basically, we input same information that we do in Money Guide Pro, but what this software does is it helps to calculate the optimal distribution strategy. Okay, so should you do Roth conversions? When should you file for Social Security? How much of a Roth conversion should you do? Okay, are you going to run out of money? And so what this software does, it gives you typically over 100 different, strategy ideas, and we kind of narrow them down. So basically, it takes into consideration your income needs, your expense management, your spend down strategy, optimize the Social Security, Roth conversion strategies. So it helps us as planners do all those sorts of things. Okay, so again, for you guys who know me, it's about the process, not the product. Okay, so the process is snapshot, compare different scenarios, figure out the distribution strategy. Okay, so that's really important. Just trying to give you a heads up for some of the software programs that we're using. And another thing that we're very excited about is that all of you who are existing clients are going to get an email the next week or so to actually get a username and password to our customized performance reports. So as many of you know, we custodian our accounts at Schwab. And so we're setting up households so spouses can, so let's say spouse A has 3 accounts and spouse B has 4 accounts. We can create households where you can see all of those accounts in one household. You can see your overall performance for the household, but you can also see the individual performance for each different account. The other thing is that we also have the ability, which kind of leads to my next polling question. Actually, I wanted to do this. I'm going to actually do my next poll is, here we go. So if you had the option to view performance reports that include the accounts we manage and the accounts outside of what we manage in real time. So let's say you had your 401k in there in addition to your Schwab stuff, or let's say a Vanguard account that you're managing yourself and we're not managing it. If you could see all that stuff in one portal to see the performance and actually how things go, would that be of value to you? Okay, is that, so as yes. The other question is that, I mean, by the way, everything costs money. So this service costs me money. So I'm just saying is that I'm happy to do it, but I want to make sure that enough people would actually do it and not just say they're going to do it. So if you're going to do it, say great. But I think this is a value added feature that, so if it's important to enough people, then we will go ahead and do it and make sure that you've got access to this. But I think it's super valuable because, again, it goes back to the question, what kind of rate of return do you need? How much do you need to save? Are you on track? Okay. So if you could log into a portal and kind of see your rate of return, I think that might be helpful. Okay. Okay. So anyway, so we're super excited about Tamarac, and it looks like 94% of you feel that this would be a valuable thing to have. So this is great. I love that feedback. So thanks so much. I'll leave that poll open. I'll keep on moving on. All right. So I want you to notice the picture on the right. Okay, we've got some sun, but we also have some clouds in the background, and so that's kind of what's going on with the markets right now. So I'm going to kind of get right into it. So I'm going to go ahead and kind of close the poll right here. Thanks for participating. Okay. So here's where we are. All right. So remember, the market peaked at the very beginning of 2022. So that's really when the Fed started raising interest rates. And remember, 2022, the S&P 500 was down roughly 19%. Bonds were down, 12%. And it was a rocky road. Why? Because we had high inflation. The Fed had to try to cool down inflation by raising interest rates. And when you do that, you're basically taking the economy off of an adrenaline. I call it, you're taking the economy off the heroin. You're taking the economy off the drugs that have really been driven it since the last bear market recession in 2008. So interest rates were super low to stimulate the economy, and interest rates, in my opinion, were too low for too long. And when COVID hit, trillions of dollars of stimulus went into the market. And then we had supply chain issues, had all sorts of stuff, which caused inflation to go up to 8-9%. Well, Fed had to reduce that. And so when you reduce that, obviously that's going to cause negative ripple effects in the stock and bond markets. Again, we've seen this before. So if you're on my market update a year ago, we talked about that when you have a year where both stocks and bonds are down at the same time, that's only happened 3 times in market history. And then if you're on my call a year ago, we were actually very cautious and kind of bearish on 2023. If you look at the chart right there, the trend, we were below that big fat red line, which is the 200-day moving average. But you saw in January of 2023 things start to rally a little bit, and we ended up positive. So, and this kind of leads to my next polling question here, guys. All right, so here's the question. Where do you think the stock market will be at the end of 2024? Where we are now is that we've regained the losses from 2022, and actually we've hit all-time highs basically in the last week or so. So where do you think the market's going? Do you think it's going to be higher at the end of the year? Do you think it's going to be flat, or do you think it's going to be lower? I'm just trying to see what you guys think. Okay, so I'm going to keep on talking while you guys kind of put your input in, but I really want to know what you're thinking. Is the market going to be higher, flat, or lower a year from now? Okay. It's really interesting. Like, as I'm looking at the polling results, it's basically we're breaking down into thirds. This is amazing. So we're about a third of the people say it's higher, a third flat, and a third lower. And I'll just I'll let people take another maybe 10 seconds or so to kind of put in their answer. But I think the higher is at 39%. So I think that's kind of people feel that the market's going to be a little higher at the end of the year. Oh, look, the flats are now pulling ahead at the 41%. This is kind of fun. So I'll keep the poll open right here for a little bit. And but while you guys are doing your poll, I'll just kind of show you. So actually last year in 2023 was actually very surprising. The stock market was up over 26%, which historically speaking from 26 to 2023, the S&P 500 is averaged a little around 10%. So historically speaking, last year was a pretty good year. So okay, I'm just going to go ahead and close the poll, and you can kind of see the results. About 42% say it's going to be flat. So that's kind of interesting to kind of see the polling results. So thank you for your participation. Okay, so last year was a pretty good year. It was actually surprisingly good. So, and I want to kind of make a comment here. All right. So I showed you all those institutional money managers that have their opinion on what they think the market's going to go. But guess what? They're doing the best job they can to anticipate what's going to happen. But you know what? No one really knows, right? So this is a lesson to learn, okay? What the lesson is that you don't want to be too bearish or too bullish, when we have these situations. I mean, so typically, when you look over history, the market tends to outperform more than underperform. And so when we're in a situation right now where the market go either way, historically speaking, you're better off to stay fully invested and be more on the aggressive side. But we're going to talk about ways that you can ratchet that risk down in just a little bit. So, but historically speaking, you want to stay fully invested because we know the markets go up and down. Okay. So last year the market was a bit dicey, but guess what? Typically when we have these situations, strength begets strength, and you can see that in most years. Now we've had 1972, 2007, so these were the times where that didn't happen. But on average, when we're in market again, new all-time highs following 12 months of consolidation. 3 months, the average return in the markets are about 3.4, 6 months, 7.2, and then a year later, almost 14%. So that shows that about over 71% of the time in 3 months, 78 and 92% of the next year. In these situations, the markets end up to be higher. That means that the momentum continues to go. So that would be an argument, historically speaking, at least, that we should have a positive year. Okay. So that's one argument for the bulls. Okay. Excuse me. But the question is, what drove the market last year in 2023? Well, this was really interesting. You guys may have heard the Magnificent Seven, but almost 88% of the returns of the S&P 500 were driven by 7, count that, 7 stocks. And actually, in terms of index by size, 100 to 500 stocks, basically contributed about 1.4% of the returns. So basically what that told us was that besides these 7 stocks, the rest of the market was kind of, it just wasn't, there is a fair amount of stocks that actually had negative performance last year. Okay. So this was just one case that, a small niche of companies just killed it and really propelled the returns. And this is a chart of that. You can see that top line, that was the Magnificent Seven. If you want to look on the right side of the screen, those are the 7 stocks that drove the returns of the market last year. Microsoft, Amazon, Meta, or Facebook, Apple, Google, Nvidia, and Tesla. Okay. Are those stocks continuing to drive? Well, they kind of are. But, the question is that, how much room is left on these stocks? We'll see, right? But, by the way, if you own the S&P 500, you own this stuff. And if you have any kind of like technology positions, mutual funds, ETFs, you're also going to own them. So even if you own a broad index, you're still going to own those 7 stocks most likely. Okay. Now, the other thing is that not only did the market do, but we also had in the fourth quarter last year, bonds had an historic, market or performance. Now, I want you to look to the left of that chart. You're going to see that the bond markets were negative from May through October. Why? Because the Fed was still raising interest rates. So as you know, as interest rates go up, bond prices go down, and opposite. So it's like a seesaw. If interest rates go up, bond prices go down. Well, what happened was that the market anticipated that the Fed was going to pause raising interest rates, and that was both positive for stocks and bonds. Okay, so you can see right there in November and December of last year that bonds were up about 8.5%. And we also feel that bonds should perform well in 2024 as well. Okay. And from a technical point of view, this is the 10-year Treasury yield. And you can see that right there, that the Treasury yield kind of peaked in October and started to fall. As I said, interest rates and bond prices go in opposite directions. So as the yields dropped, bond prices go up. So we've seen the last week or so that the 10-year Treasury is starting to go up a little bit, and it's put a little downward pressure on bonds. But I think that's a short-term trend versus a longer term trend. So again, we still feel that bonds are going to do well. And again, one reason why is that that the Fed kind of peaked their interest rate hikes, and there's actually anticipation that the Fed is going to cut interest rates, which would be another big boost for bonds. Okay. So this is a recap of the bond market. So if you look on the left side of your screen, that was 2022. Obviously, big drops. Last year, bonds for the most part kept on falling until the fourth quarter, and then we had a nice little rally. So where the bonds are right now is kind of sort of the all-time high where it started in 2023. Again, we feel that the bonds are stabilizing, are actually a really good buying opportunity right now. In fact, we feel that bonds are a better opportunity than cash for sure. I'm going to talk about that a little bit more in a few minutes, but ultimately that big fat red line is the 200-day moving average, and that's a positive chart from a technical point of view, is that we have broken the 200-day moving average, which is a very bullish sign for bonds. Okay, so that's good. And so we kind of talked about this. So when you talk about the potential Fed interest rate hike pause and historical bond performances, again, we've seen this cycle in the past. So when the Fed has dropped interest rates and has raised them, okay, we've seen this before. What has historically happened? Well, cash was a great place to be in 2022 because both stocks and bonds were down. But the question is that when should you start cycling out of cash and going into stocks and bonds? Okay, well, the answer is like fourth quarter last quarter. So you can see right here that in this kind of money, this kind of scenario, you see the far right money markets on average do about 4.5%. But look at on the far left, U.S. core bonds on average have done about 11.5%. Okay, So one of the things that that happens, I see this all the time, is that people sit on a lot of cash. It feels good, it's liquid, it's not subject to market risk, but guess what? You are paying a huge opportunity cost right now being in cash. So again, just from a financial planning point of view, ideally you want to keep maybe 6 months living expenses in cash, but much beyond that, it's like you need to be thinking of how to put that money to work. So we're going to be showing you, we're going to go into detail why that makes sense, down the road. Okay. Let me go over here. All right. And so again, so the performance following the peaks in inflation, you saw that inflation peaked in June of 2022. Things have dropped, and you can see that on average, stocks have performed about 18% in the next 12 months after that, and bonds almost 7%. And so that's pretty interesting. Now, again, so from June 2022 to September 2023, stocks were up almost 16%, but bonds were down 4.1 during that period of time. But now, as you saw in Q4 last year, that bonds had a rally, and we should still see. So that's that -4 should turn positive, or maybe it's already turned positive at this point. Okay. So anyway, you can see those things right there. Now, the other thing is that we're in a presidential year. Oh my God, I'm so sick of this primary stuff. It's driving me crazy. But anyway, enough about politics. But the question is, well, how do the markets historically perform in election years? Well, historically speaking, election years tend to be sluggish in the first couple quarters and tend to pick up speed in the second half of the year. So we'll see if that remains true. But the other thing too is that we're going to talk about this in just a minute, but if a bear market recession happens, it's most likely going to happen in the first half of this year. Okay. So that would be kind of in line with historically what's kind of going on. But again, we'll see what happens. But typically in an election year, things start to perk up in Q3 and Q4. And also historically speaking too, when Trump was elected, the market rallied. I think the anticipation was lower regulation, lower taxes. Boom, the market went up. But guess what? When Biden beat Trump, the market still went up. Okay, so we've seen historically that whether the left or the right is in the presidency, the markets still tend to do well after that election is done. Okay, so anyway, all right. So we talked about the soft landing or bear market recession. So, okay, this leads me to my next poll. All right. So here's the question. Are you concerned about a bear market recession? Not concerned, somewhat concerned, very concerned. I want to kind of test the temperature of you out there in webinar world. What do you guys think? Are we going to have a recession? You're not concerned, somewhat concerned. What are you guys thinking about? I want to kind of see what you guys are feeling. Okay, I'll let. So actually, what's interesting, we got about 80% are somewhat concerned. Okay, you know what? And I would actually agree with the sentiment out there. We got some more polling people. We got some that are not concerned, some are very concerned. Okay. But I think if we look at the bell curve, I think some people are somewhat concerned. Very good. I always like to see what people are doing and thinking. All right, I'll leave that polling question up a little bit. All right. So the soft landing, I love this the picture of the woman on the obstacle course. And that's kind of what the Fed has been doing, trying to find the right amount to keep things going in terms of the the interest rates, and I think they're actually doing a fairly decent job. So far, we've actually had a soft landing. So what is the definition of soft landing? And basically, it's just the goal of the central bank is to seek when they raise interest rates, they do it just enough to kind of stop the economy from overheating and experiencing high inflation without causing a severe downturn. So that's the definition of a soft landing. And actually, I think the Fed has done a pretty good job of raising interest rates. It's always a little painful when it happens, but I think they did a pretty good job at doing that. Okay, so, but here's the case for the bear market recession. Okay, All right. And so we saw in our polling that I think the majority of you are somewhat concerned. I think that's probably a good mindset to have. Okay. All right. So again, I go back to my website. I got this information from these sources that I shared with you. Again, as I said, highly recommend you download Anatomy of Recession and the Guide to the Markets from JP Morgan. Two great sources. All right. So here's the take. A lot of this is taken from the Franklin Templeton, Guide to the Markets right here. Okay. So who is right? If you look on the left side, we actually see, GDP increasing. It was starting to increase Q4 last year and the first 2 quarters of this year, But also, if we look at, so nominal GDP, what is nominal GDP? So GDP is the gross domestic product. Nominal GDP is the gross domestic product minus inflation, okay? So typically when you actually have, nominal GDP falling, that is not a great sign, okay? So again, we're kind of 50-50 right here. So there's about a 50-50 chance the U.S. will be in a bear market the first half of the year, although we're encouraged about a few more yellow indicators. So if you look at the U.S. recession risk indicators, you can see in December 31st, just less than a month ago, that we've seen a couple more yellow cautions versus the red X's. Okay, so we're cautiously optimistic. And the thing that has been keeping the economy going is that unemployment's still been low and people are still spending money. Okay, now what the concern is that a lot of the stimulus money has kind of gone away and a lot of student loan money. So, they kind of paused student loans for a period of time. And now, we're starting to see some student loans that they got to start repaying that. So we're going to kind of see what happens. Also, just again, the interest rates to get a mortgage or a car loan or those sorts of things have gone up. And so it literally costs more money to buy a home. Okay. So when those interest rates go up and your mortgage payment goes up $1,000 a month or something like that, that's literally less discretionary income for the average American to spend on other goods and services. Excuse me. So that's sort of the concern about what's kind of going on. Okay. And so, again, when I was giving this presentation a year ago, this has been the most anticipation recession ever. This has been going on for quite some time. So they've been saying, the recession could happen, but it didn't happen last year. And so far in 2024, it still hasn't happened. But again, so this is the probability of a recession over the next 12 months. Okay. But it always starts as a soft landing. So when you look at this chart right here, it starts off as a soft landing, but then you kind of see the gray area around just 2008. That's where the bear market happened. You also see 2020. That's when we had the market meltdown of COVID in March of 2020. So we've kind of seen these periods where it started off as a soft landing, but certainly ended up in a bear market recession. So, that's just kind of keep that in mind. And another thing too is that, again, historical declines in the leading economic indicators lasting more than several months have foreshadowed economic downturns. So these economic indicators have been declining for over 20 months. Okay, so remember, the economy and the stock market are two separate things. Okay, the stock market is more of the hare or the rabbit, and the economy is more of the tortoise. Okay, so the stock market is going to go up and down these bursts and speeds, but the economy is more of the tortoise being kind of slow and steady. And so what we've seen right here is that historically, on average, a recession has historically begun a little over 3 years after a rate cycle gains momentum. So if I do my math correct, 3 years is roughly 36 months. Well, we're only into this about 23 months. Okay, so things are looking good. That's why I show the sunny fields, but we also have some clouds in the background. Okay, so that's just something to take into consideration. So we are not out of the woods yet. Although, while things are good, you want to stay fully invested and take advantage of the market as it's making money. Okay. All right. So again, on average, recessions historically have begun a little over 3 years after a rate hike cycle gains momentum. Okay. Now, and you can see right here in this slide that when things turn around, it can turn around negative very, very quickly. So you can see in previous recessions, 4 quarters before the recession, GDP was up 2.3. 3 quarters, it was up 4.6%. The previous quarter, the GDP was up 0.8%. Okay, so GDP was actually a little higher than that right now. But you can see that, recessions things are good until they're not. And when things start to turn, it can happen very quickly, and you're kind of caught off guard. So what I want to make sure you guys are all prepared for a bear market when it happens. So again, please stay to the end because we're going to go over 10 ways that you can kind of prepare yourself for that. Okay. All right. So this brings up my next polling question. All right. So here we go. So if the market drops another 20%, actually, I should put that in 2024. Sorry, that was a typo on my part. But if the market drops another 20%, say 2024, what would you do? Would you do nothing, stay the course? Would you make minor changes? Would you sell some equities, raise some cash, wait for an opportunity? Or would you sell everything and stay in cash until the market comes back? So what would you guys do? So, if the market drops 20%, how are you guys going to handle that? I'm kind of curious to see what you're thinking. You're going to stay the course, going to make some minor changes, sell some equities, raise some cash, kind of wait till things start to feel better, or you just say, listen, I don't like this at all. I'm going to get out. I'm done. So anyway, I'm just kind of curious to kind of take the temperature of you guys out here on the call. All right. So it looks like about 40% of you are going to do nothing, and 40% say maybe make some minor changes. Okay. That's reasonable. So I'll just kind of, I'll leave this poll question up here, and I'll just kind of keep on going here. I'll leave it up for another, 20 seconds or so. All right. But guess what, guys? We've seen this movie before. So you see that roller coaster and people getting sick over the roller coaster. So again, the investors are more likely to feel anxious and make emotional decisions when they only focus on the investment returns and not their overall financial plan. Okay, and that is absolutely the case of what's going on. So all right, I'm going to go ahead and close the poll, but it looks like about 45% of you would make some minor changes. About 35% of you would do nothing. So that's some interesting, but I think that's about right. That's kind of the consensus about most people that I kind of work with right here. Okay, now, if you want to put this in the chat, I'm kind of curious to see what you're thinking about this. So here we are on the emotional roller coaster. All right. So here we are. Where do you think we are? Are we encouraged, confident, thrilled, euphoric, or are we more surprised, nervous, worried, or panic-stricken? I'm just kind of curious to see where we are in the emotional cycle. Kind of based on the polling stuff, you guys are kind of maybe, I don't know, encouraged, maybe or maybe you're a little nervous. Maybe we're on the downside of that. Maybe we're a little bit nervous on where things go. But I'm always trying to kind of see where you guys are kind of feeling things. Bob said encouraged. Anybody else? How are you? Where you guys land in the emotional roller coaster of the markets right there? Anyway, you can just kind of put in your feedback. Larry, nervous, worried. Kurt, surprised. Jim, surprised and nervous. Bonnie, nervous. Okay, I hear you. Well, Ben said just another day. I love it. There you go. Surprised and nervous. Phil is just a little bit nervous. Okay. Ray says Maria says she's encouraged. All right. That's cool. So sort of a mixed bag right there. But guess what? It's okay to be nervous and it's okay to be encouraged. All right. The main thing is be prepared and have a plan. All right. So again, one thing is that when you're putting together your strategy, right, you need to be thinking about what motivates you. All right. So people are either motivated by one of two things. They're either motivated by the fear of missing out, or they're motivated by the fear of loss. Okay. And so Win said, I'm unattached. Okay, I got it. All right. So I think this is a really important thing because investing is as logical as we want to be. Investing is emotional. And so you really need to understand what motivates you. Is it the fear of missing out or the fear of, of losses? Okay. So one of the things is that if you have the fear of losses, what that tends to do is lead to um, basically, quite frankly, investor mistakes, where they get out after the market has dropped, and they get back in after the market's kind of gone up. So it's really hard to time the market, and there's all sorts of investor mistakes that people make. And so when you look at the average investor, you can see they've done about 3.1% over time from 2003 to 2024. But actually, if you just kind of bought and hold and stayed in stocks, they did almost 10%. Okay. So really what this tells us from a psychological point of view, it's really about your threshold of pain and what do you do when the markets, drop to a certain level. Okay. And so if you're existing clients of mine, we talk about that a lot and different ways that you can minimize losses in the portfolio. And guess what? It's not just your portfolio. There's other ways that you can go about that, which we're going to get into. All right. So, I think the main point that we're trying to make is that don't fall victim to panic attacks. Okay. Markets do this all the time. We've seen the movie before. And as I also mentioned, that a big common mistake that people make is that they stay in cash too long. Okay. And I showed you that previous slide is that cash is a great place to be 2022, but right now there's some more attractive places to be. Okay. And I love this slide right here because what this does is this shows you what the markets do intra-year. Okay. So look on the far right. The S&P ended up a little over 24%, but guess what? At one point, it was down -10. Last year, the stock market ended up at -19, but at one point it was -25. The previous year, it was down -5, but it ended up +27. Okay, so what I'm showing you right here is that despite the average intra-year drops of 14.2%, that's the average, the annual returns were positive 33 of 44 years. Okay, which means that there are more sunny days than rainy days. Okay, so I just want you to really, look hard at this slide, and I want you to look at all those negative numbers. And you can always, so for most, actually all of them, the negative numbers, the market didn't end up as negative as the lowest negative day of that year. Even in 2008, at one point, the market was down 49%, but it ended up at -38. Well, that was a really bad year, but still, the whole point is that, if you have the risk tolerance is the lack of a better word, but basically the ability to kind of hang in there. But I think that we also have to be aware of that. We are emotional humans, and we need to be aware of that. We need to be aware of our investor behavior. Okay. So I said, are you more motivated by the fear of missing out or the fear of losing money? Okay. So ideally, we want to have our cake and eat it too. We want to capture as much of the upside of the market as we can while minimizing losses. That's kind of what we want. We want to kind of narrow that bandwidth. We want to kind of compress that a bit. So remember, by minimizing losses, we can preserve our portfolio, address sequence of return risk, and also potentially allow for more of our estate to be transferred to our heirs. So there are advantages of minimizing those losses when the markets go through these periods of times, right? But here's the thing. I want you guys, again, you're working with me, and if you're not, you need to be, because you need to think strategically about how you put this stuff together, okay? You need to think outside the box of just your investment returns. It's really easy to look at your statement and say, oh, I'm down 10% or I'm down X amount of percent, and say, wow, I'm really unhappy. Okay. But if you actually do planning and look at things holistically and have a plan on how you deal with certain situations, that anxiety kind of goes away. And guess what? For my clients who I've done this with, my phone does not ring off the hook when we go through these cycles. Okay. So what we ideally want to do is we want to stay fully invested. Now, that could be 100% equity. It could be a 60-40 portfolio. That kind of goes into your risk tolerance, right? But whatever your risk tolerance is, whether it's a growth in income or more of a growth or an aggressive growth, the ideal thing is to stay fully invested, but take a holistic approach to overall planning, okay? So I want you, instead of timing the market, I want you to think strategically about how you're going to solve problems, okay? So this is kind of where the planning comes into play, all right? So have a plan and know exactly what you're going to do. I think that's the message I'm trying to get across. And also, again, what motivates your investment decisions? I guess I'm repeating myself over and over, but is it the fear of missing out or the fear of losses? Okay. But I think the most important thing is the mindset, is that you've got to be proactive and not reactive, and you have to stay engaged. Okay. One of the biggest frustrations I have as an advisor is a client who just disengages. They just ghost me. It's like you reach out and say, you're just shaking, hey, this is what's going on. You need to do this. And it's crickets. Okay. They are disengaged. And this happens far too frequently. So if you're disengaged, there's no way I can help you. And if you're disengaged, quite frankly, you're not watching the boat unless your plan is so good that you've got it and you're good. You put it on cruise control. Hopefully that's the case. I'm going to give you the benefit of the doubt. All right. But savvy investors understand what motivates their investment decisions, and they take the time to construct a portfolio that adjusts to constantly changing markets, reduces volatility, and also minimizes taxes. Okay. They utilize insurance products to offer benefits that investments don't. Okay. So again, just big picture, many advisors, financial advisors, are either very investment centric, where every problem can be solved by their money management and whatever they do in their portfolio. Okay. A lot of advisors are in that camp. They don't really deal with insurance products. Okay. There's also another group of advisors that are not securities licensed. They call themselves advisors, but their solutions tend to be insurance products. Okay. Philosophically, I feel that you need to have both of these tools in the toolbox to optimize your situation, okay, your finances. You need to understand these tools and to be able to use them to optimize your situation, okay? Now, so let's kind of talk about the tools in the toolbox, okay? So before I get into this, okay, at the very beginning of the presentation, we talked about why we do Money Guide Pro, because we need to take a snapshot of what you have. We need to go into the financial lab, and we need to model various situations. When should you file for Social Security? Should you do a Roth conversion? When should you do this? How did that? How are you going to pay for a major capital purchase? Those sorts of things. Okay. So once you do the modeling and figure out your income strategy, or if you're not retired and you're in the accumulation phase, what tools in the toolbox are available to you for your particular situation? Again, these are literally tools in the toolbox. So I'm just going to share with you some of these tools. Okay. The first thing is, so again, this is 10 ways to grow and preserve your assets. And also, I should have added in here to address a bear market recession. Okay. So my first thing is professional tactical money management. Okay. So the concept is this, is that if you look on the left side, we kind of see, the concept of, do you want all the ups and all the downs, or would you prefer 3/4 of the up and 3/4 of the down? Okay. I'm kind of in the camp that I'm totally fine getting 3/4 of the up if I'm only getting 3/4 of the down. All right. What that does is that compresses the volatility. It also makes me sleep better at night because my account might be down, but it's down much less than the market. Okay. So that's sort of the concept right here is that and this also helps when we're actually in retirement in terms of income predictability. Okay. So again, if your approach is to buy and hold an index, you've got to be comfortable with your portfolio dropping 25 to 50%. Okay. And that's fine. If you're cool with that, if you want to buy the C fund and the TSP or the S&P 500, knock yourself out. Okay. Keep your expenses down. But just understand the flip side of that is that if you're going to take a buy and hold approach, you've got to be willing to stomach the emotional roller coaster. And as we kind of saw in the polling, is that a lot of people don't feel comfortable with that. Okay, so again, you need to understand how you feel, but you also need to make sure that your portfolio is in alignment with how you emotionally feel about investments and risk. Okay. Love this slide right here. So if the market drops 10%, you need an 11% rate of return to get to the break even. But guess what? If your portfolio drops 40%, you need a 67% rate of return to get to the break even. By the way, if it dropped 50%, you need a 100% rate of return to the break even. We can mathematically do that. Okay. And that's in the accumulation phase. Well, what if you have transitioned to the distribution phase? Now you're actually pulling money out of your accounts. Well, let's say that you stick to the 4% rule, where you take out no more than 4% of the value of your portfolio on any given year. Okay. Well, if you take out distributions in a falling market, if the market falls 10%, you need a 40% rate of return to get to the break even. If the market drops 40% and you're pulling out 4%, you need a 150% rate of return to make up for those losses. Okay. So it's critical that we minimize losses in the accumulation phase. It's really important to minimize them in the distribution phase when we're going through our portfolio. Okay. So how do we do that? Okay. So and just for you guys who are not familiar with me, I am independent. I work for you. I don't work for any particular company. So I've got access to all the major institutional money managers, or I can, again, I manage my clients' money and my personal money for many, many years, up until roughly 3 years ago, where my business got to a point where it just became too much, and trying to place trades over, 300 or 400 accounts, it just became too much. So I actually outsource my money management to the institutions and kind of look at their models. And so my point is that I use a lot of the BlackRock stuff, but I could still use Vanguard. I could use Fidelity. I could use anybody I want to. But where my personal money is and where many of my clients' money is, and there's many different models, but this is one that is really kind of piqued my interest, where we're kind of moving a lot of people to this. There's a model called the GA Select, and by the way, it's in the handouts that I put, so you can download the handouts and the thing, and also you should hopefully receive an email with a link to these handouts. But I have brochures on this kind of stuff. So why is my personal money in this portfolio? Well, one thing is that it's the most flexible, proactive management that I've kind of seen. And by the way, it's super inexpensive. The actual internal costs are super low. So what they're doing is that they use a combination of ETFs and great mutual funds. And what I've been a big ETF guy for many, many years, and I've kind of steered away from mutual funds. And the reason being is that many mutual funds, there is a $25 or $50 transaction fee that Schwab charges when I buy and sell a mutual fund. And so, especially when you got people taking money out of their accounts, and you got 3 or 4 funds, you start taking money out, that really kind of starts eating away of your performance when you have all these different transaction fees. Well, the cool thing about this particular portfolio is that there's a handful of mutual funds in there, and they're all on the Schwab transaction-free list. So when we buy and sell these mutual funds in this portfolio, there is no additional trading costs, which is great. So that's awesome. Second is that we could have a debate whether active or passive management is better. Guess what? I don't care. So in this strategy, we've got both active and passive strategies, which is kind of neat. Now, one thing that I like about what these guys are doing is that they've got an international team and they understand what is moving the markets. And so this particular portfolio, they're doing a little bit more trading than my target allocation ETF model. So they're a little bit more proactive. And I'll give you an example. We got this thing going on in Israel right now. And so you've got the big attacks on all the oil tankers and, in that part of the world. Well, so how does that affect the price of oil, in the global market? So it's, again, supply and demand. So that would be an example of maybe we should own a little bit of energy. So right now they own a 1 or 2% position in XLE, the energy ETF. We're also supporting, a war in Ukraine. Well, hopefully we're going to continue to support the war in Ukraine, but we're also supporting Israel. All right. So we're giving them all this, all these these bombs and all this kind of stuff. Well, ultimately they need to be replenished. So don't you think there might be some opportunities to actually buy the companies that are actually manufacturing our weapons that we use? So that's another thing. So there's an ETF that buys the companies that has the defensive stuff, or like defense, like bombs, planes, those sorts of things. So the point is that what a professional institutional manager is doing is that they understand what's moving the markets. They look at the geopolitical risk. They look at all this kind of stuff and say, you know what? I think we see some opportunities over here, but we also see some areas where we wanted to de-risk, and so they can underweight certain areas. So those are the types of things that we're kind of talking about. And again, you can download and look at the information. But ultimately, they've got an entire team of investors, analysts, and I'm like one guy. Okay, so these guys have a lot more resources than I do, and quite frankly, they do a great job. So it just makes sense for me. My business as a comprehensive advisor who focuses on retirement income planning, that's what I want to focus on, doing all these kind of things. I want to leave the money management to the guys who that's all they do. Okay. So they're actually using alpha strategies that seek to for outperformance and the downside protection. And so what they do is, and also the alpha strategies is that, again, they're tactical. They look for opportunities. They minimize risk when things drop. And so they're trying to, again, minimize the downside, but also give really good upside. Again, also using index strategies, a lot of ETFs, super low costs. There's a thing called factor investing. You can go to my website and go to the money management page and learn about factor investing. Okay. So my point is that they've got all the tools in the toolbox to do a great job of managing risk. And there's also, if things really start taking off, let's say you're in a 60-40 portfolio, they have the ability to go 10% positive or 10% negative, depending on what the markets are doing. So if things are just killing it and things are taking off, they can increase the percentage of equities. Or if things start to really drop and we start to go into a bear market recession, they can take that 60-40 portfolio and maybe have 50% equities. So they can reduce the amount of equities, but they can also change the allocation of maybe having high quality stocks, minimal volatility stocks. Those are the types of factors that we're talking about. So anyway, I got a lot more to cover, but the point is that they got all the tools in the toolbox to ultimately have the best ratio between return and risk. So that's why my personal money is in it, and many of my clients. Okay, and this gives you a visual of how the portfolio looks. So you can see there's a plus or minus 10% deviation between equities and fixed income. And as the markets kind of, swirl around, you can see the portfolio also changes as well, and it kind of reacts to the market and on a proactive basis. Okay. And this is what the net result is that, it doesn't lose as much and it outperforms them and positive markets. And you kind of see the returns kind of below there. Again, You can download. I got all this kind of stuff. You want to dig more, deeply into it, but that kind of gives you an idea. Now, what you're thinking is that, well, my money is not in that. Well, I think I'm doing a pretty good job. So, well, let's see. So what we have the ability to do is that we can take your portfolio. So if I have a most recent statement, and I literally have the tickers and the number of shares, I can actually take the tickers and the shares and run a report and compare them to all these different types of portfolios. We can do apples to apples, and you can see how you're doing. You can see the performance. You can see the amount of risk. You can see the tax consequences. Okay, you can see how well diversified or how lack of diversification you have. Well, my point is, and this is something that we're going to do in our reviews. Okay, so again, if you're an existing client of mine, we're going to kind of reach out to you, and you're going to kind of tell us when you want to do your review this year. But that's one of the things that we're going to do for the monies that we're not managing, like your 401k or other accounts. We can actually get that stuff, run performance reports, and kind of show you how you're doing compared to what we're doing on our side. So just kind of, it's, if that's something that you think might be, helpful, just kind of put that back in the, in the chat. And actually, while I'm doing that, there's a couple questions in the, in the chat. So Ben Du said, how about engaged in passive investing? Yeah. So Ben, again, I use both passive and active investing. So there are pros and cons. And that's something we can certainly talk about offline. But as I kind of said, with passive investing, you just need to be aware that when the markets drop, and when I hear about passive investing, it's more taking a buy and hold strategy and, let it kind of do that. Well, again, that goes back to, what are you motivated by? Are you motivated by the fear of missing out or the fear of losing money? And so my point, the camp that I'm in, Ben, is that if we have the ability to actually know with a reasonably high percentage where a market is going, like for example in 2022 when the Fed was raising interest rates, we knew that bonds were going to drop. Okay, well that's investments 101. So if you're taking a passive approach and you bought the aggregate bond index, for example, you had negative returns. And this is investing 101. So in tactical management, it's more about understanding in that fixed income or equity portfolio, which sectors should we underweight and which ones should we overweight. I'm not talking about making massive moves. I'm talking about making a little adjustments. And that's the only way that we can kind of minimize the volatility. That's where, again, I'm perfectly fine with getting 75% of the upside if I'm only getting 75% of the downside. So that's kind of where you can't get that strategy when you're doing completely passive investing. That's the issue. Okay. Wynn said, please explain Roth conversions and when or why you would do that. I'll do that really quick. Wynn, a Roth conversion is when you've made contributions into a tax deferred account. And the reason why you would do that is if you feel that taxes are going to go up at some point. One of the things I want to talk about in my tax course is what we call legislative risk. You and I have no control over what Congress does with taxes. We literally have zero control. They don't even know what they're doing. All right. So the advantage in a nutshell of doing a Roth conversion is that you're locking in paying taxes at that rate and you're done. So I'm going to go into that a lot more detail in the upcoming seminars that we're going to be doing. Okay. So just want to answer a couple questions right here in the chat. All right. So that is one thing. So we also have the tax loss harvesting. Okay. So if you are an existing client of mine and you have a non-qualified account, which means it's a taxable account, your account is over $50,000, you are automatically getting proactive tax loss harvesting. So for those of you who are not familiar with that, is that all tax loss harvesting is that, let's say you've got a diversified portfolio. The market drops. And so what happens is that, let's say and here we go. All we're doing is that the market drops, we lock in that loss, and we actually replace that position that we just sold with one that's very, very similar. So we lock in those losses, that basically offsets the gains in the portfolio. And if you do that enough time over the course of a year, you can really neutralize your capital gains tax. So here we are at the end of January. In 2 to 3 weeks, you will get your statements from Schwab that will have your short-term capital gains, your long-term capital gains, your qualified dividends, and your ordinary dividends. Okay. Short-term capital gains and ordinary dividends are taxed at your ordinary income tax bracket. Your long-term capital gains and your qualified dividends are taxed at long-term capital gains rates, which most people, that's 15%. If you're in a higher tax bracket, it's a little higher. So ultimately, what we're trying to do is that we're trying to minimize the amount of tax on taxable accounts. And here's another question for you. If you've got a taxable account and you look at you log into your Schwab account and you say, hey, I got 10% of return that year. Okay. Is that the actual return that you got? The answer is no. And why is that? Because your actual return was the rate of return minus the taxes that you paid. Same thing with an IRA or 401k. If you got 10% in your IRA or 401k and you took money out, well, that's not the rate of return. The rate of return is that minus the taxes, and that's what you have to take into consideration. So a lot of people will have $1 million in their IRA or 401k, say, hey, I'm rich, I'm in great shape. Well, guess what? That money is not all yours. Roughly a third of that or a quarter of it is the government's. That's another reason why you want to do the Roth conversions. Like you can lock in that tax bracket. All right. So here's an example. Let's say you own the S&P 500 in your portfolio with the ticker SPY. That's the spider. And you basically you sold it. Let's say the S&P 500 dropped. You sold it. You took the loss. It's what we call a realized loss, and you actually bought the BlackRock version of the S&P 500, which is ticker IVV. Vanguard has their thing. Everybody has their S&P 500 fund. This is just an example. All right. So the reason why we're doing that is that there's a thing called the wash sale rule, which means that I cannot, or you cannot, sell a position, take the loss, and buy the same position within 30 days. That actually voids. It's called that's the wash sale rule. And if you do that, you cannot take that capital loss to offset capital gains. Okay, so that's the situation with that. So again, the advantage of tax loss harvesting is that up to $3,000 a year of capital losses can offset capital gains in 1 year. So if you got more than $3,000 of losses, the remainder of those losses can be moved forward to the next year. So I've had clients that have had like major capital losses, and they do what they can. They just kind of keep on forwarding that until that those losses are done. The other thing is that the advantage of it is that the desired allocation stays the same. And you also can defer your tax liability until it's realized at a future date, which is also really neat. The other thing too is with tax loss harvesting, you can potentially turn short-term capital gains into long-term capital gains. And so when you pull the money out, they'd be taxed at a lower tax bracket. Okay. So you could defer those gains until you're potentially in a lower tax bracket. And the other thing too is that the way you understand from an estate or legacy planning perspective is that upon death, if we have, let's say we had a stock or a mutual fund or an ETF that we bought 1 million years ago, it's got a low basis, and we die, our beneficiaries get a step up in basis to the amount of what the position is worth on the date of death. So that's another thing too, is that if you got these positions that have very low, you got a low cost basis, maybe you don't want to touch them, and ultimately upon death, those beneficiaries will get a step up in basis. So there's a lot of advantages of tax loss harvesting, and this is something that you need to be doing if you've got these accounts. Okay, so what we're looking at right here, I'm just looking at the chat right here. Is it helpful to have annuities to minimize taxes when you're in a higher tax bracket? Michelle, that's a great question. I'm I'm going to get back to you on that because you're a few points ahead of me, but I'm going to show you how we can use annuities to kind of deal with taxes. But I'm going to answer your question in just a few minutes, Michelle. Thank you for answering the question. Okay, now here's an example. Here is my personal account. So to show you what a geek I am, this is what I do on New Year's Day when everybody else is relaxing, having fun. I'm actually looking at all my finances and seeing how I'm doing. So I just took a snapshot of my capital gains tax for 2023. Okay, so you can see on the right, here are my proceeds and my cost basis. And you can see right here that last year in my personal account, I had no long-term capital gains, and I had $1,129.23 of short-term capital gains. Okay, in over a $200,000 account, that's pretty damn good. So that shows you what tax loss harvesting. So those are the realized gains. That's the actual. So when I get my Schwab statement in February, that's what it's going to say. It's going to say, Jim, you had $1,129 in short-term capital gains. That's going to be taxed as my ordinary income tax bracket. But guess what? I'm cool with that because that's not that much money. Okay. Well, so those are the realized losses in 2023. Well, did I make any money? Well, the answer, actually, let me go back to this. So basically, my realized gain was 0.44% or 44 basis points. That is really good. I am super happy with that. Okay. Now, did I make money? The answer is yes. I was up nearly 16%. And quite frankly, in the first half of the year, I was taking a more of a conservative, kind of risk off posture. And I still made, in my gains, I was up, nearly 16%. So you can see so I still have a cost basis of 162,457, but the market value at the time was 203. Actually, the value of the account right now is like over 210, just because we've had a little bit of a rally in the market, which is cool. So what I'm kind of showing you, like literally with my personal account, is why this stuff works. Okay. So again, if you can either do this on your own, but I could promise you are not going to do as good a job as a third party that this is what they do. They've got algorithms and systems that are so complex and advanced. They've got stuff I use a company called 55IP. And that's what they do. They basically take the models of these institutional money managers, and then they actually place the trades, and they also do all the tax loss harvesting. So that's what they're doing. Okay. So I love the woman there with the little orange piggy bank, but ultimately, when you have this strategy, you've got good performance, you got less volatility, you got less capital gains. You also have a net after-tax higher return. Why? Because the amount of taxes that you paid were far less. So as I remember, I'm going to repeat myself again. Is the rate of return on your statement the true rate of return? The answer is no. It's the rate of return minus the taxes that you pay. So that's how you have to compare this portfolio versus something else. All right. So we're on to the third. So I got 10 of these right here. So I'm going to hit them pretty quick. All right. So Dividend Plus. For those of you guys who are not working with me and haven't been on my previous webinars, we have a proprietary money management program called Dividend Plus. It was created by a guy named Larry Taunt about 11, 12 years ago. Okay. So Dividend Plus is a strategy that's designed for retirees who are retired or people who are very close to retirement. Okay. And so let me kind of give you a story behind this. So Larry had a client that actually got a settlement of roughly $1 million. And Larry's client said, hey, listen, Larry, I just got a settlement of $1 million, but I need to generate $60,000 a year in income, and I don't want to go into principal. I am acutely aware of sequence of return risk, but what can you do for me that can you generate basically 6% of income on a portfolio and not go into, principal? Because ultimately what most people do is that they sell actual positions of stocks, bonds, mutual funds to raise capital. So they're actually selling shares to raise capital, which are going into principal. So the idea is to not go into principal and generate the income. What can you do? Well, here's the concept. If you're not familiar with the concept called dividend aristocrats are S&P 500 companies that made a very, very strict definition. And in order to be a dividend aristocrat, you have to not only raise your dividends each year, but you've got to do that consistently for at least 25 years consistently. So these are plain vanilla blue chip stocks like McDonald's, Procter & Gamble. I don't know. There's some of the biggies in there. And so there's three different ways that you can make money in this type of management. One is that you make money off the net asset value of the individual stocks that you buy. Second thing is that if all you did was buy the stocks, there is a dividend from these things. Again, that they're dividend aristocrats. And so you're going to average roughly 3.25%, 3.5% in the dividends that come from the individual stocks that you own. Okay, so that's the second way that you can make money. The third way that makes this strategy unique is that they're actually proactively buying covered call options, which basically is just a way that you're basically selling you're selling somebody the option to buy your stock at a certain level. Okay, now, so let's just do a quick recap. You're buying dividend aristocrat stocks. You got the dividends that are coming, but you're also you're actually selling the covered calls. So there's three different outcomes. Either the market, so the covered call means, so let's say you sell a call, let's say the underlying stock price is $100, and you sell a call at, let's say, 105, hypothetically. So what that means is that if the market declines, someone just paid you money for the option to buy your stock, and they buy the covered calls every 90 days. So after 90 days, if the market declines, the option expires, you keep the premium dollars. 2, the market remains flat, you didn't hit the threshold, you still hold the stock, but you still remain, you keep the premium. Again, that's in your money market account. The third option is that the market increases, the investor keeps the premium and collects and keeps any dividends paid. So ultimately, they sell the stock, and more likely the case at a profit. And now you've got cash because you just sold the position. And now then the portfolio manager will actually buy that stock back or another stock that they feel is appropriate. So that's essentially how it is. And at the end of the day, we're able to generate roughly 6%. Income or dividends net after all fees and expenses. And so this is a great strategy for those who are, want to take income out of their portfolios. So again, just to give you a little bit more detail, the minimum account size is $250,000. And the reason being is that we need to have some degree of diversification. So they'll buy, 10 or 20 companies. They may have the VIG is the Vanguard dividend ETF. EEM is for emerging markets, but in many cases we'll own the SP 500 and also Triple Q, which is the Nasdaq 100. All of those positions you can basically sell covered calls on those. So we're not only what we're able to do is we're able to buy individual stocks, but we're also to buy some ETFs that also gives a little more diversification and still essentially do the same thing what we could do with the covered calls. So the larger the account values, the more diversification we get. And once we get over $1 million, also that's sort of a break point of sort of the advisory fees in the money management. So if you have some interest in that, we can certainly kind of talk. Oh, the other thing too is that if you already own a bunch of stocks, we can actually keep those in the portfolio and not incur any kind of capital gains tax if they're in non-qualified accounts. So it's a very flexible type of strategy that is designed to generate income. But also the other thing too is that, I'll leave this with one more point. In 2022, when the stocks were down -19, the bonds were down -12, Dividend Plus was basically flat for the year, and so it dramatically outperformed, stocks and bonds in a down market. Last year was the exact opposite. So the S&P 500 actually, outperformed Dividend Plus. And actually, so what's interesting is that Dividend Plus actually had a slightly down year last year. So there's going to be markets where Dividend Plus is going to dramatically outperform the S&P 500, but there's going to be some markets where it underperforms the S&P 500. Okay, so this is where you have to understand what you're getting into before you're going into it. But again, the thing is that when you look over a 2-year period or a 3-year period, it still has performed extremely well. So again, this is just another tool in the toolbox that we can certainly kind of talk about if you have some interest. And by the way, if you have some interest, let me just show you one more thing right here. I'm going to do the share, and I'm going to switch the screen to this. If you go to my website and go to the money management page, which is right here, scroll down, and I actually have a webinar that I recorded with Larry Taunt, which is the webcast. So you can actually watch this webinar we recorded about a year ago that goes into a lot more detail about Dividend Plus. Okay, so let's kind of go back here to the presentation. So let's do this and this and that. Okay, so all right, so switching gears. So the next thing is that we talk about Roth conversions. So this is kind of what's going on with Roth. So this is another way that you can preserve your estate and minimize taxes and so forth. So let's kind of think about what's kind of going on. So what you're looking at is the history of taxes, and income taxes have only been around since like in 1913. And historically, we're at taxes have averaged almost 57%. So if you had $1 million portfolio in, let's say, your 401k or IRA, you're in a 30% tax bracket, federal and state. There's your $700, and there's you have the IRS gets their $300,000. So that's kind of what's kind of going on right there. So historically, taxes are low. And this is kind of what's going on. On the left side, you can see this is where the taxes are today. So let's say you have income, and your income is, let's say, $235,000. I'm just making it up. So 235, you are in, and you're married filing jointly, you're in a 24% tax bracket. But if you look on the right side, $235,000. If you go back to the Tax Cuts and Jobs Act, which will most likely expire at the end of 2025, you're making the same amount of money, but now you're in a 33% tax bracket. Okay, so this should light a fire under many of you that we need to be talking about doing some tax planning. Okay, so especially those of you who are close to retiring or have just retired, and you're sitting on a lot of money in qualified accounts. Okay, so we've got this window of time between now and the end of 2025 to do as much in Roth conversions as possible. Okay, so again, we got a short period of time to deal with these and lock in your current rates. Okay, and so by the way, I kind of mentioned I'm going to be giving you guys will all get the invitation to the Roth conversion seminar that I'm going to be doing sometime, hopefully in the next couple of months. Okay, so that's that. I'm not going to go into that, but that's another. So Roth conversions is another way to actually preserve your estate and your assets. Okay, now many of you on the call are clients of mine that we've talked about different distribution strategies and how to use annuities in various ways. There's annuities. There's lots of different types of annuities. You could have some with income riders, some without income riders. And so one of the things is that there's a strategy. And this is what actually I want to be doing a podcast on this, and you guys will get this in the next month or so. But basically, there's a distribution strategy called the safety first or flooring approach. And just to kind of, for those of you who may not be familiar with this approach of distribution planning, is that there's a couple different schools of thought. You've got the probability-based approach, where a person primarily focuses on safe withdrawal rates to ensure that they meet the retirement income needs. Okay, this is a very investment-centric, kind of person. That's their philosophy. we're just going to take money out of our accounts. We're going to make sure we don't take out more than 4%. And, if we get a bear market recession, we'll kind of make some adjustments, but we're just going to kind of take our money out. And the probability-based approach, those people tend to be comfortable with a 90% probability of success, okay? The Safety First Advocate takes a bottom-up approach to meet their retirement income requirements before addressing their discretionary expenses. So the idea right here is that, okay, let's add up my monthly expenses, my stuff that I can't do without, like my mortgage and my food and my insurance and my gas, that kind of stuff. So the Safety First Advocate says, listen, I want to make sure that my basic expenses are covered by guaranteed income, regardless of what the stock market's going to do, okay? And I'm not comfortable with a 90% probability of success. That 10% really, really makes me nervous, and I don't want to take that risk. So I want to make sure that my living expenses in retirement are covered regardless of what the stock market does, okay? So what the concept is that you want to receive lifetime guaranteed income from various annuities to cover basic monthly expenses in retirement. So philosophically speaking, we believe that retirees should have at least two sources of guaranteed income in retirement. And Social Security is going to be one of them, but two is either going to be a pension or two, an income annuity. And by the way, Social Security and pensions and annuities, they are all by definition annuities, okay? Annuity is a good word, not a bad word, okay? Now, the advantage of the Safety First approach is that you've got a lot more predictable income, which makes retirement income planning and tax planning a lot more accurate and a lot more easy to kind of deal with. And also, if your portfolio is not going up and down, there's less anxiety when the market declines, okay? So we talked about that emotional roller coaster, okay? That's one way of doing it. So again, with a fixed indexed annuity, again, I'm not talking about variable annuities. I'm talking about fixed indexed annuities. So there's no losses in bear markets because basically the principal is protected, okay? So what annuities are doing is that they're serving a number of functions. One is that they're addressing market risks because your principal is protected. Two is that they're addressing longevity risk, which means that the annuity is the only product that guarantees income over 1 or 2 lives, that if the account value goes to 0, it's still guaranteed an income. Okay, your investment portfolio physically, literally cannot guarantee it will not run out of money. Now, you may have a lot of money, and maybe because you're smart and didn't take it all out and you stayed under that safe withdrawal rate, you're okay. But the point is that the annuity really address the market risk as well as the longevity risk. Okay. The other thing too is that when we actually start running the numbers, the amount of capital necessary to meet those retirement income goals tends to be less with annuities versus safe withdrawal rates. Okay, that's kind of going into deep things as well. And let me just see if there's, I thought I saw a couple of little things. Are there any other questions in the chat? I'm just seeing if there's any other things right here. So Michelle asked, some annuities does not mean that you have to annuitize the money, but take it out as you wish. Michelle, yes. So as I said, there's 5 different types of annuities. The ones that we're talking about in my example right now with the fixed annuities is that they tend to, their purpose is to have your own pension plan. So all fixed indexed annuities, you're able to take out 10% penalty-free withdrawals starting in year 2. So there is some liquidity. There is a surrender charge. So if you take that money out, within the surrender charge, there may be penalties. But again, the way we construct our retirement income plans is that there's plenty of liquidity from other sources. And but yes, so with some annuities, it depends on what you're going to be using them for. Again, this is just literally a tool in the toolbox, and this is where we kind of start talking about different plan designs and the different products when we start designing these kind of strategies. So that's a great question. Okay, so going back to things. Okay, we just talked about fixed indexed annuities with an income rider to kind of raise that income floor. You can also use fixed indexed annuities with no income rider to help minimize taxes and Roth conversions. Okay, so I'm giving you a little sneak peek of my Roth conversion seminar coming up in a couple months. Okay, now, by the way, this is why I spend time to go into conferences and surrounding myself with really smart people who've got, great ideas. I did not know about this strategy until April, May of last year. Okay. So I'm going to share with you a strategy that I've been talking to a lot of clients about. And when they kind of understand what's going on, it's like, well, why wouldn't I do that? It's like, yeah. Okay. So check this out. I'm showing you something that you guys have never seen before. So, all right, pay attention. Okay. So first of all, there's a little known Roth conversion strategy that can only be implemented through a licensed advisor like myself. Okay. So you literally cannot do this on your own. All right. What the strategy uses is a unique fixed indexed annuity that has the ability to convert from an IRA to a Roth IRA within the same contract. Okay. Think about it. So you got an IRA, you fund it with X amount of dollars. It goes from IRA to IRA. It's a trustee to trustee transfer. There's no taxes at that point, but you have the ability to convert to a Roth within the contract. Okay, remember that. And if you're not familiar with fixed indexed annuities, we've got different index strategies. Okay, so what the index is, what an index is that you're actually buying an option on an index. You're not actually buying the index, you're buying an option on the index. And typically these index strategies are 1 year, 2 years, 5 years, or 7 years, typically, okay? And how it works is that you fund the policy, you got an annuity that's been issued, and it's been issued on a certain date, and the index is valued at a certain amount at a certain date. And what happens is, let's say if you got a 1 year index, a year goes by, and if there's gains in the index, you lock in the gains, you get a percentage of the gains in that index. Okay, that's how it works. But for that entire period of time, you've had no growth on a statement because the growth hits at the end of that index period. Okay, so if you got a 1 year point to point, from the time that you got it to 365 days later, it's credited, on that anniversary date. Okay. If you have a 5 year index option, and this is the key, pay attention. The index crediting, the growth in the contract does not get credited until the end of the 5th year. So when you're looking at your statement, let's say you put in 500,000, I'm just making up a number. So for 5 years or 4 years and 11 months, the value is $500,000. Your statement does not show growth. Although, in reality, it is kind of growing over time. It's just not crediting the indexes at that point. Okay. So, and also you got participation rates, which going to definition of participation rates, because ultimately, how much do you participate in the index? Okay. And you also have professionally managed volatility controlled index, which actually brings the cost of the options down, and it also has very good performance over time. And the best thing about these particular annuities is that there's no fees. Nobody likes to pay fees. All right. So with this particular product, there are no fees. So people like that. Okay. So here's the concept. Let's say you funded one of these fixed index annuities with $500,000. So here's your IRA. So here's step one. You determine how much you want to contribute. You fund the annuity from qualified pre-tax accounts. That's what happens. So because we chose a 5 year index option, we have frozen the growth for 5 years. All that growth over 5 years will be credited at the end of the 5th year. I'm going to keep on repeating that because this is a key component of the strategy. Okay. Now, here's what happens. So that's step one. Step two is that we're going to convert a portion of that annuity into a Roth. Okay. You convert that annuity, but you got to pay the taxes on that with money outside of the annuity. Okay. Remember, you can do a Roth conversion, in any kind of account. But you ideally wanted to pay the taxes with money that's outside the IRA, what we call a non-qualified account. Okay, that's also key. Again, so the growth is deferred to the end of the 5th year. So in my example, you got $100,000 at the beginning. So at the beginning of year 2, you got $100,000 in the Roth, you got $400,000 in the traditional IRA. Okay. Again, just like any other Roth conversion, you determine on how much you want to convert. If you don't want to convert, that's fine. You still have the advantages of the annuity where you have the principal protection. If you did want to annuitize it, you could if you wanted to. But my point is that there are major advantages of the annuity just to have in your portfolio from a management and risk point perspective. So if you want to convert, you can. If you don't want to that year, you don't have to. There's no one forcing you to do that. Okay. All right. Step 3. Next year, you convert more money to the Roth. Okay. We keep on doing that. And basically what happens is at the end of the 5th year, now what we've done is that we've converted the entire IRA to a Roth, paid the taxes on it. And since we chose the 5-year index option, the growth is deferred until the end of the 5th year, and all the returns are credited to the Roth IRA. All right. Hopefully, like the light bulb is going off in your head saying, okay, hold on. Let's think about this. So we started off with $500,000. I now have $500,000 in the Roth plus the growth. Yeah, I pay some taxes on it, but now this is kind of where we are. And now that Roth IRA is tax-free money. Okay. So during that Roth conversion period, would you rather pay taxes on the future growth or freeze the growth in the IRA for 5 years, which ultimately may lower taxes, and have 5 years of index returns credited to your Roth IRA? Okay. So if you take this strategy and say, well, I don't want the annuity, I'm just going to do a Roth conversion from my investment account. Okay, well, there's 2 scenarios. One is that the market does really, really well, and so you convert a little bit, but that rest of in my example, 400,000 continues to grow. Well, if that continues to snowball and you want to convert the whole amount, you're ultimately going to be paying more taxes because you're paying taxes on the growth of that IRA. That's scenario 1. Scenario 2 is that we got a bear market recession. So now your $500,000 portfolio is now down to 475, 450, 400. And now your principal has dropped. Okay. So now you've lost money. You're down 20%, 30%, 40%. Now, there's an argument to do conversions while that value is down. That's cool. But bottom line is that you lost your principal. Okay. So my point is that you can do Roth conversions in accounts outside of the annuity, but just understand you're taking on market risk, and you potentially may be paying more taxes because the growth keeps on snowballing, or the market could drop in your IRA could be less. All right. So you got to be thinking about, those, what could happen. All right. Brilliant idea. We'll be doing, so watch this seminar. If you guys have interested, if anybody on this call is interested in doing Roth conversions, please talk to me because you need to, I can go in more detail about that for you. Okay. Number 7, got 3 more and we're wrapping it up. Okay. So here we go. The other thing too is I got to make sure that hopefully this won't automatically end. So hopefully I didn't have this turn off automatically. So here we go. The Index Universal Life. So one of the most underutilized financial tools is cash value life insurance. Okay. People think about life insurance is only benefit is death benefit. Wrong. Okay. The way that we use cash value life insurance for my affluent clients is that we actually want to minimize the death benefit and maximize the amount that you put into it. So if you look at all the characteristics on the right, you've got tax deferred growth, tax-free distributions, competitive return, high contributions. Remember, you're limited to how much money you can put into an IRA or 401k or a SEP or even a cash balance plan. So you can have much higher contributions in cash value life insurance. You can have additional benefits. We use cash value life insurance a lot with chronic illness and long-term care riders to help pay for long-term care costs. By the way, just like the fixed indexed annuity, we actually use this where we index universal life policies where your principal is protected. It means you can't lose money. You're also guaranteed to be able to borrow money from your own policy. And unlike a mortgage or a car payment, which are structured loans, these are unstructured payments. So if you borrow from your own policy, you don't have to pay yourself back, or you do. So, but the main thing is that you got liquidity use and control of the policies. So ultimately, where we're using the cash value life insurance is that the death benefit is tax-free. You got tax-free policy loans. Again, you got moderate growth, principal protection. It helps to pay for long-term care expenses. And by the way, when there are two different places that you can put money tax-free after doing a Roth conversion. You can put it into a Roth IRA, A, or B, you could take those after-tax proceeds and actually fund a cash value life insurance policy and get all these other benefits. And we've got the ability to kind of run that and show you how that turns out. Also, one of the best ways to actually transfer assets from one generation to the other is through cash value life insurance. Okay. There's also the private reserve strategy where, again, you can go on my website, go to the life insurance page and watch the little video. What the private reserve strategy is, it's a way that you use, you're using collateral of your life insurance policy to borrow from it and to make a major capital purchase, such as a car or a college or whatever. You basically kind of pay yourself back. And by doing that, you're not touching your investments. So the key to wealth, as you know, is compounded interest uninterrupted. And by using the cash value life insurance to make a major capital purchase, it allows your investments to continue to grow uninterrupted. Okay. All right. A couple more ideas. So when you're growing your portfolio over time, the question is, actually, I was just looking at, Larry's stuff. He said, if I bought a fixed index annuity with an income rider in late 2019, can I take advantage of the Roth conversion strategy now? Larry, in your particular account, most likely not, but I can look into that for you. You've got the AIG, the income rider. I'm not sure if we can convert that to a Roth in that particular product, but we can look into it. Great question. Thanks for paying attention. Okay. All right. So 4K. Okay. So when you are building your portfolio and you say, okay, I'm building this nest egg for retirement. Besides your normal lifestyle, what are you going to use this money for? You need to be thinking about this. I think one of the biggest sources of expense, especially as we age, are healthcare costs. Okay. So I'm not trying to push any kind of insurance or long-term care or whatever. What I'm just saying is that, okay, as we age, the chances are our expenses are going to go up and we need some care. What's the best way to pay for it? So there's a product by a company called Global Atlantic. It's called 4Care. And what it is a hybrid fixed annuity with long-term care riders. And so essentially what I love about this is that you got your principal protected. So you put in, I'm going to make it up. You put in, let's say $100,000 and you have the option to, and that's going to grow at normal fixed annuity rates, which are kind of mid-single digits. But you also have a second component, which is that long-term care policy. And the way it works is that you're, depending on your health, you're either going to get 3 times the initial premium or 2 times the initial premium. Okay. So what you do is that the way that you're going to reposition this is that, let's say you've got money, you've got non-qualified money, you've got money and non-IRA money. So you can take that, do a single premium into something like this. We've protected your principal. We're getting money market plus, kind of rates of return with no risk. And we also have now either doubled or tripled our resources for long-term care. And by the way, if we go on long-term care claim, that money comes out tax-free. Contrast that with, okay, well, if I don't do something like this and I have to self-insure, if I got to pay $8,000 that month, it's going to come out of my IRA. I got to pay taxes. If it comes out of my taxable account, I got to pay long-term capital gains, and it's dollar for dollar. With this kind of strategy, you can put money in, and you're either going to leverage your premium dollars either by 2 or 3 times that. So you can see, so the contract value maybe $200, but day one is that your long-term care bucket could be 400,000 or 600,000 if you get issued preferred. So anyway, Claudia, thanks for joining us. Sorry, I went a little longer than I wanted to tonight, but thanks for joining us. Okay, so these are sort of the highlights of this particular product, and so again, you can leverage your benefit 2 to 3 times. You got principal protection, tax deferred growth. And typically the benefit is income tax free if it's coming out for long-term care expenses. You got a guaranteed minimum interest rate, and also the contract value itself passes on to the beneficiary. Okay, so it's just another way to really leverage your money in this particular product. And so again, this is just a tool in a toolbox. Okay. Now, there's another thing if you want to kind of address the long-term care stuff. You've got another great company is called One America. They have the Asset Care product, by the way. If you go to my website, to the long-term care page, I actually have a couple of videos on this. So what this product is basically a hybrid whole life policy with long-term care riders. Okay, the 4Care was a hybrid fixed annuity with long-term care riders. This is a hybrid whole life. But by the way, Asset Care, they also have a thing called Annuity Care. So they do a similar thing with annuity as the main chassis as well. Okay, now this is a potential solution where, okay, so here's the challenge. Most people's wealth are tied up in 2 places. One is that in their qualified accounts, such as their IRAs, 401ks, all that pre-tax dollars, and also in the equity in their home. Okay. Well, most people don't want to go into the equity of their home, so they got to take money out of their qualified accounts and pay taxes on it. Okay, so what's kind of neat about this is that this is the only product where you can actually fund it with pre-tax dollars. And the way it works is that you figure out how much you want to contribute to this. Okay, let's say $100,000, or whatever it is. I'm just using $100,000. So what you do is that you fill out the application, and we run an illustration, and okay, so now we transfer $100,000 from wherever the money is to this Asset Care product. Technically, you're filling out 2 applications. You're filling out a fixed annuity application, and you're doing the hybrid life / long-term care policy. What happens is that your initial premium goes into the fixed annuity as an IRA, no taxes at that point. And what we do is that they just take out 10% penalty-free withdrawals from the annuity to fund the life insurance. Technically, you're funding the life insurance over a 10-pay. You're paying the premiums over a 10-year period, but you're funding the annuity once. The reason why that's key is that you are, if you just wanted to pay for the policy as a whole, out of your IRA, you'd have to pay taxes on it, and you get a 1099 for that distribution in that 1 year. The way they're doing, the way One America is doing it, is that you spread out those premiums over a 10-year period, so you're dramatically reducing your tax liability to go with this. So it's a great way to do it. Ultimately, you get a 1099 from One America each year for 1/10 of the initial premium. Okay. And then you got the LTC benefits that can be payable, over your lifetime or over both insureds, which is kind of neat. And again, the death benefit can pass to the heirs. And again, the cool thing about the premium used for Asset Care is that it's no longer subject to stock market losses or bear market recessions. Okay, so again, it's just another tool in the toolbox. And finally, on number 10, I'm wrapping things up. I'm like a half an hour longer than I want to be, but it's just great stuff. Is that the main thing is that you want to stay engaged with financial planning. Okay, so the thing is that when you go to the website, you look at our service, what we do is that one thing that differentiates me or our firm from other advisors is that for the price of very reasonable money management advisory fees, you're not just getting institutional money management, you're getting comprehensive retirement planning, which includes financial tax reduction planning and implementation. You're getting institutional money management of your choice. Again, access to Money Guide Pro, which is basically financial planning software, which also does retirement planning, retirement income planning, Social Security planning, tax reduction planning, insurance analysis, and also legacy planning. Okay, so that's my value proposition, is that we're providing all these different services with the same basically advisory fees that a money manager or stockbroker charges to manage your accounts. But you also get unlimited phone conversations, review meetings. Hopefully all of you guys are receiving our weekly market updates. We got the performance reports, and we also have the client events, and also as the amount of money that we manage goes up, we have volume prices. So that's the other thing. And again, we get the performance reports that I kind of mentioned at the beginning. We're doing reviews. So again, for those of you who are clients on the call right here, one thing so Robin's going to reach out to you tomorrow, and one of the questions is that when would you like to schedule your quarterly review? Q1, 2, 3, or 4? And so we actually in the handouts, we actually have a sample template for an agenda of what do you want to kind of talk about. So we want to make sure that when we do our reviews, they're productive, and we focus on the things that you want to focus on. But so we're providing these services for you, but we also feel that your adult children should have access to the same resources that you do. And so again, what we're asking is that, introduce us to your adult children, just an introduction. It may not be the right time, but if they want to schedule time with us, we'll give them access to Money Guide Pro. We'll answer those 4 questions. What kind of rate of return do you need? How much you need to save? How much, when can you retire, and how much of your standard living will you have to reduce? So ultimately, we can answer those questions and get them on board, and actually give them an analysis of their financial. And again, it's free. We just want to make sure that we include the families. And I'll just tell you a quick story. I know I'm running long right here. I had a client. Her name is Kathleen, and she was kind of getting up in age, and she had 3 daughters. And I started working with, one of the daughters who became power of attorney of her accounts. Ultimately, Kathleen started kind of getting some dementia. She went to an assisted living facility, and we had fortunately got things going. We had the power of attorney, and we get a call from the daughter saying that, hey, listen, Kathleen has, she's kind of in hospice right now. Things are not looking so good. And so by having her in the loop, what we were able to do was we ultimately, she had a small IRA that would ultimately have to, be distributed to the beneficiaries. But what we did was that we actually liquidated the IRA. That means that the proceeds were taxed on her tax return. Cash was raised to deal with her funeral expenses and the estate expenses, and that way it was much easier to have that money be distributed to the beneficiaries. Okay, so my point is that this is real life, guys, and hopefully you guys have good relationships with your children. But the main thing is that by getting them involved on some level, when stuff like this happens, they're there, and we can help, and we can set stuff up, which ultimately saves them time and grief. And it also, the main thing is that someone has to deal with that estate. And so if we can minimize the time and the aggravation to deal with that kind of stuff, you're going through a grieving process. We want to make sure that things are set up as cleanly as possible. So that's really important. The other thing too is that if at some point your children are going to be inheriting your money, don't you think it's in their best interest, in your best interest, that they have financial education so they know how to handle it properly and they don't make foolish mistakes? So if they're working with us and we're working on planning, we work on a plan to make sure that their current finances are set up, But if they do inherit money at some point in the future, we're going to be talking about the best ways to do that. So when you're working with an advisor like us that specializes this thing versus not, the chances of someone who's not working with an advisor making really foolish mistakes just because they don't know any better is really, really high. So anyway, I just want to kind of bring up that point. So again, I also just encourage your family to stay engaged with financial planning and education. So as I just said, we just feel that your adult children should deserve the same kind of resources as you do. So kind of help us help more people. So we just kind of ask, hey, just, we're going to send you, actually my bio is in there. If you just send an email and CC us to friends and family, we'll kind of take it from there. We'll just say, hey, I just want to introduce myself. If you'd like to get together, that's great. If not, that's totally fine. I just want to introduce myself. So we're not hassling people, not trying to spam people. We're just trying to introduce and just say, hey, if you need our help, we're here for you. And so ultimately, that's kind of, so where I can use your help, guys, is that, again, email my biography to people who feel that you feel can actually use, really take advantage of our services. Invite them to our workshops, subscribe to my podcast once I get it going, and it kind of help things going. So anyway, just as a recap, again, the key to financial security is a commitment you make to yourself to stay engaged with financial planning. I cannot help you if you disengage and you ghost me, okay? So we're just trying to encourage people to stay engaged. That's why, let's schedule time sometime this year for your financial review. It could be fourth quarter, doesn't matter to me. We just got to put it in the calendar, okay? So again, schedule me with Robin and we'll update the Money Guide Pro, update the financial spreadsheets. We're going to review your performance reports. We can actually, compare your outside accounts. We can look at all that kind of stuff where you need to know. Also, again, so what we're going to do is that, we schedule me with Robin. She's going to do that. Robin and I are going to kind of discuss the case. And then we're going to, here we go. Honey, I'm wrapping things up. I'll be there in a minute. Thanks. Anyway, so we're going to be doing that. And then also, you can forward my bio to your adult children, plug them into our financial education, and also subscribe to our YouTube channel. Okay, so anyway, that's the end of my presentation. Sorry, I went a little longer than we anticipated, but I appreciate those of you who are kind of hanging in there. Actually, we got a lot of people still left on the call. So anyway, that was my wife calling me and saying, where are you? I was supposed to be home like 20 minutes ago for dinner. But anyway, I wanted to, if you guys have any questions, I could stay on for another minute or so. But I mean, ultimately, we're going to kind of follow up with you tomorrow and to kind of see if you'd like to schedule a review, like, this quarter or next quarter, whatever. If there's anything else that you want to kind of talk about. But I also noticed there are a number of people here on the call who are actually not existing clients, which is great. So we can certainly kind of, if you want to schedule time just to kind of talk and see, see about things, we can certainly do that. Nona, thank you. She says, go eat dinner. So I'm going to wrap things up. I'm going to take Nona's advice and, and call this a night. So anyway, listen, thank you guys for joining me. Happy New Year. I look forward to talking to you in the near future. And we really wish you the best. And I'm going to sign off and you guys have a great night. Okay, take care now. Bye.